What do we find is that there is another thing which is very interesting, and that goes to financial condition. That when there are tighter financial conditions, we have a link which is stronger and the curve is steeper. When we have loose financial condition, we have a flat Phillips curve. And in this case, we are almost able to explain why the correlation of the Phillips curve, this parameter, keeps changing and becomes smaller and smaller and smaller. And that depends when we have loose financial conditions. So when we go back a decade or more and we think of the zero lower bound interest rate and the quantitative easing, or the post-pandemic reaction with the huge fiscal deficits, so you have huge monetary policy reaction, etc., 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 you have very loose financial conditions. And so it doesn't matter, the Phillips curve goes flat. So it doesn't matter what the job market is doing, inflation will behave in its own way and it will follow the business cycle. In fact, the whole dialectic, the whole narrative of a wall of demand because of this or that or the other, it can be true for the first or second quarter, but it does not explain the business cycle. So, because inflation is not temporary. Inflation is not temporary, and the business cycle is not a temporary feature. So it's not a short sugar high of demand that it has been pushing prices higher.